Let's get across the open now. Zach Rio's joining us from Banyan Tree Investment Management. Zach, welcome back. Good to see you. Look, we're still in wait and see mode as far as trade, tariffs. Donald Trump has set a deadline for countries to get back with a deal, in fact, tonight. Meanwhile, of course, the US dollar has been under tremendous pressure as that notion of US exceptionalism evaporates. What are you seeing?
Yeah, good morning. What's interesting is, obviously, look, you've seen the taco term being thrown around with the US president. Trump always backs down or to that effect. I think people are becoming a little bit fatigued by this stop and go. But look, you look at the US dollar, and obviously 10% down this year. This is one thing, look, when we talk about, what may sustain this equity rally, don't forget a 10% decline in US dollar is really positive for a lot of the S&P 500 companies. It's very positive for a lot of the Australian companies trading overseas and dealing in US dollar, whether it's the revenue base or the cost base. And so don't forget in the upcoming half-yearly quarterly result, this is going to be a key positive. And so look, what's really interesting is I haven't overlaid on this chart yet, but if you overlay the S&P 500 over the US dollar, they normally trade side by side, but the relationship's broken. US equities continue to rally, the US dollar continue to decline, and it could be due to what you just suggested, US exceptionalism on the fade. We don't think so. We think there could be an argument if data continues to remain resilient in the US, that the US dollar may play some catch up. But as per this chart, this is showing good positive potential catalyst for earnings per share growth for companies heading into quarterly and full year results in Australia.
All right. Well, obviously, that's also that lower US dollar has been beneficial for gold as well, hasn't it?
Absolutely. And don't forget, lower US dollar is beneficial for also liquidity in the rest of the world, as long as the US dollar remains a global reserve currency. And so, EM is a major beneficiary. Global equities, ex-US is a major beneficiary. So there's a lot of follow-on effects from a lower US dollar. So my point more specifically today is just that earnings per share, because obviously everyone's looking for that impact from tariffs, and you may see a positive surprise, at least on that front.
All right, positive for earnings. Look, obviously that's Donald Trump likes a lower US dollar, as does he like lower oil prices. He's got his way on that front as well.
Absolutely. It's very interesting. OPEC, driven by Saudi Arabia, has gone very hard on increasing the production, despite oil prices obviously being a laggard. But so putting that aside, and that obviously will appease Mr. Trump. But you put that aside, again, a lower US dollar. Again, I'm talking from an earnings perspective. Industrial companies, logistics companies, they will benefit from this decline in oil prices. And from a consumer perspective, don't forget the US consumer is now moving into a elevated demand period, summer holidays and whatnot. So lower gasoline prices could also be positive for consumption, within roundabout ways could be positive for earnings. But from a cost perspective, the recent decline, you can see, the oil price has gone from nearly around $80. This is WTI to $63. That's going to have some positive impact on those that are trading in spot, energy costs. So again, another catalyst potentially to look out for from a positive perspective in upcoming earnings season.
And on top of that, of course, we have the big, beautiful bill sponsored by Donald Trump himself that he's trying to get through Congress at the moment. His idea, of course, that's going to boost consumption with significant tax cuts. Interestingly, overnight, Elon Musk calling it an abomination, saying it's a complete waste of money. That's particularly given, and I guess some analysis coming out, that this is really only going to benefit the top income earners in the States.
That's important. That's an important point to realise, that I think the 60% of the benefits go to the top guys, and this is an independent organisation, Tax Policy Centre, and you can see, I think the lowest income earners are going to get less than 1%. But if you think about that, right, it's the big income earners that tend to spend the largest part in terms of consumption. So from a equity perspective, it is not fairly spread out, but nonetheless, these tax cuts should, at the very least, provide some sort of positive sentiment, or at least some sort of driver for consumption. Look, in terms of Elon Musk, I think his whole concept going into this election and post-election was cuts. And I think, to be honest, his ego has been hurt a little bit around the whole Dodge and what that's been able to achieve. Any of us who've had some sort of insights into the political sphere know that it's a different beast. And whilst your intentions and your strategic clarity may be there, once you go inside the machine, it's very hard to get some of the outcomes you want coming from a private sector. And from what I've seen, he claims $300 billion from independent studies, $30 billion of Dodge. And I think that's, he's probably right around the spending. But Andrew, my point is, I think this administration, for all said and done, will end up largely following the same trend in terms of deficits and whatnot. So It's, I think, business as usual from my perspective.
Well, both maybe Elon Musk and Donald Trump realising that perhaps you can't run the country like you can a business.
100%.
Let's come back home. What are you seeing on the Australian market at the moment? I mean, you're fairly, obviously, positive about what we're likely to see ahead for the US market. What about Australia? Yeah,
look, we're balanced. But we are keeping a very balanced approach, and we're looking for opportunities. So a recent company that we've added to our portfolio is Treasury Wine. This is a company that we normally don't look at, but the valuation looks screamingly good value. But look, that is not without warrant. This is a 2-year forward PE multiple, blended forward. So, 2 years from today, this is what, if earnings hold up, it's trading on 10 times, giving a yield about 4.5%, 5%. Now, it's recently come out with the CEO having left the company, but they've been very decisive, very quickly. They've hired a ex-Lion executive to take that position up, so that uncertainty is gone. What that does represent for some people is that, whether he comes and starts slashing earnings. And well, what do you know? It happened yesterday. Post the earnings upgrade, which, mind you, this is the important point, some of the operational and end market challenges that Treasury Wine is experiencing, I think was already well understood. So when they came out with a downgrade yesterday, it was largely in line with where consensus was. So in fact, after that, the share price was weak initially, but ended up being in positive territory. And that's what we're suggesting to our clients. At current value, at current multiples, Treasury Wine largely has all of its challenges baked in. And with a half decent yield, it's looking decent. And we don't think, look, the position and the end markets of this company haven't completely disappeared. And so we continue to see good long-term potential double-digit earnings growth for Treasury Wines. And so I think at these levels, the risk reward is really attractive.